Hi, and welcome to the December 2016 Downtown Pittsburgh IBD Meetup. My name is Eric Rossi. I'm a co-organizer for this meetup group. And included on this first slide is a link to our meetup page in case you found this video on YouTube. If you're interested in joining the meetup group or seeing what other resources are available on the meetup page, then you can use the link shown here. The mission statement for this group is to educate individual investors about the CAN-SLIM investing strategy, which was developed by William J. O'Neill. So this means identifying the best educational material that's available, whether it be books, webinars, videos, etc. This presentation is educational in nature. I'm not recommending any securities to buy or sell. Investing in stocks does carry substantial risk, and you can lose your capital. I'm a non-professional volunteer investor. Investors Business Daily, IBD, and CAN-SLIM are all registered trademarks of Investors Business Daily, Inc., and MarketSmith is a registered trademark of MarketSmith, Inc. And finally, Meetup is a registered trademark of Meetup, Inc. And the prerequisite for this presentation, certainly you can watch this without having met this prerequisite, but if you want to get the most out of this and understand the concepts most readily, I recommend that you at least have read Bill O'Neill's book, How to Make Money in Stocks, and the latest edition is the green one, which is shown here. The topics for this month's presentation: first we'll go through the market dashboard as always, then we'll talk about the S in CAN-SLIM, then we'll go through current watch list, a market analysis, we'll look at current holdings, and then if we have time we'll talk about some recent trades. So the market dashboard, right now we're in a confirmed uptrend, and this has been true basically since Trump was elected as president. The current uptrend is very old. It's one of the oldest this has been one of the longest running times when I've seen IBD keep the market pulse in a confirmed uptrend or an uptrend under pressure. So the market hasn't been under correction since June of 2016. So usually usually the market doesn't run that long without some type of meaningful correction, and this is a testament that it was a tough second half of the year to make a lot of meaningful gains. Certainly some stocks did well. We had Weibo, we had Nvidia, so there were some stocks that did really well, but all in all the market was kind of trading sideways for the second half of 2016. And now we're moving into new high ground in 2017, which is exciting. But the market does seem like it's a little bit extended right now, and a pullback would not be a bad thing. But we'll just have to see what happens. Who knows? This could run for another year without a market correction. And the distribution day count, at the time I did this, we had 4 on the S&P 500 and we had 7 on the Nasdaq. Those numbers have come down by 1 since I prepared this presentation. But either way, 7 is a pretty high number still. I believe that a lot of these are going to be dropping off pretty soon unless we have new distribution days. So this will probably turn to yellow pretty soon. The Fed activity, the Fed raised interest rates another 25 basis points in December of 2016, and they said that 3 more rate increases are being considered for 2017. So generally in a rising interest rate environment, the stock market tends to not perform as well. However, one variable here is that with Trump being elected and with a lot of the changes that he wants to make in the administration, that seems to be viewed favorably by the market right now. So that might negate the Fed activity to the point that these rising interest rates are not going to cause a meaningful market correction. We'll just have to see what happens here, but historically, rising interest rates are a bad thing for the market in general. The S&P 500 right now is, it's above its 50-day moving average, its 200-day moving average, and year to date we're up 1.3%, which is actually quite a lot if you think about the fact that we're only 2 weeks into the new year, a weekend, actually 1 trading week. So it's hard to imagine that kind of performance continuing, but for right now, The accumulation distribution rating is a B minus for the S&P 500, and we got a B for the Nasdaq. So those both get greens. And then the IBD 50, which is a composite of the 50 top stocks generated by Investors Business Daily. The IBD 50 is a composite of those, so they're kind of meant to be the top growth stocks at any given time. So that index is above its key moving averages, and year to date it's up. One interesting thing here is that you can see that the IBD 50 is lagging the S&P and the Nasdaq. So growth stocks are overall lagging the general market, which is not ideal. Ideally, the market seems to do best when the Nasdaq's outperforming the S&P, which it is doing right now, and then when growth stocks are outperforming the Nasdaq. And this part of the market dashboard is unchanged. The last bull market, we're currently still in a bull market, which started in March 2009. So historically, this is one of the longest running bull market cycles in history. So the longer we run in a bull market cycle, the greater the probability that we're going to have a meaningful pullback that's going to put us into a bear market. And the last bear market ended in February 2009 after the financial crisis, the housing financial crisis. And then one thing I like to look at is the number of intermediate corrections in the Nasdaq. And these are corrections generally like 10 to 20%. And we've had 9 of these in the current bull market. So that's a lot. And we're overdue for one right now, in my opinion. But again, with Trump being elected president here, maybe we won't see one for a while. But anyways, we got a yellow and a red and a red. So you can see overall we've got a lot more green, especially the shorter term indicators on here have turned green recently. And we've only got we got a few reds and we got a few yellows. So overall the market dashboard is looking okay. Okay, so let's look at we'll continue in our series. We've been looking at one letter of the CAN SLIM strategy each month. So this month, we're going to look at the S, which stands for supply and demand. So just to review here, CAN SLIM is the acronym developed by William J. O'Neill, and it describes his methodology of investing in growth stocks. And last month, we covered the N for new. This month, we're going to cover the L, or the S, for supply and demand. And this material comes from Chapter 6 of Bill O'Neill's book, How to Make Money in Stocks. And that was the green book I showed earlier in the presentation. So Bill O'Neill says that the price of almost everything in your daily life is determined by the law of supply and demand. And he also says that this basic principle applies to the stock market. So, going by that logic, stocks that are in high demand are going to tend to perform better because people are going to be buying them and thus bidding the price upwards. And stocks that are not in demand are going to tend to not do that. So he also said that smaller cap stocks that trade fewer shares are more volatile than large cap stocks. And that's pretty easy to see if you look at stocks like Amazon, Facebook, Netflix. They tend to move slow. They tend to move at a slower rate because they've got such a huge following in institutions, and there's just a lot more shares available. There's a lot more shares out in the market, a lot more money vested in them. So they're going to tend to move more slowly than a new stock, like a new IPO that is relatively undiscovered and trades a lot fewer shares and has a lot less liquidity. So it's a lot easier for those smaller cap stocks to move bigger than it is for these larger cap stocks. So Bill O'Neill did point out that smaller cap stocks do tend to outperform larger cap stocks if all other factors are equal. So it certainly doesn't mean that small caps outperform in every case, but there tend to be more opportunity in the smaller cap stocks. So we want to also look for companies where top management owns a sizable percentage of stock, because this means that they're invested in making the company succeed. So if the CEO owns a lot of shares and his management team owns a lot of shares in the company, that's a positive thing. If they don't own any shares in the company, you have to ask yourself, well, why is that? Do they know something that the rest of us don't? Are they really not that interested in the company's success. And likewise, it's a positive development when companies buy their own stock over a long period of time. You might hear this called stock buybacks. So larger companies are often run by more conservative management, and I work for a large company right now, and I can definitely attest to that. They're less willing to innovate and take risks as compared to smaller entrepreneurial companies. And we're seeing this more and more nowadays, where these small companies come out, and some entrepreneur forms some new company, and they do something that really disrupts a certain industry, like Airbnb, for example. Really disrupting the hospitality industry, or Uber now disrupting the taxi industry. And so these new companies are coming out, and they're willing to take these big risks and really innovate and really think different. And as a result, that can create tremendous growth if their idea takes off, as opposed to, compare this like Uber's potential for growth with their brand new idea that's really disrupting the industry, compared to a traditional taxi company who is probably just going to maintain the status quo because they weren't doing anything different. And in fact, now they're probably losing market share because of folks like Uber that have come out. So as a result of that, larger companies often lack the impetus to stimulate a large increase in sales and earnings growth as compared to smaller companies. Companies with low debt to equity ratios are safer investments than companies who are more highly leveraged. So it's good if a company has lesser debt. Companies with a lot of debt can have big moves in their stock, but we just don't want a company that's over leveraged, particularly now in a rising interest rate environment, because if a company has a significant amount of debt and interest rates start rising, that means that the cost of their debt is going up. So I like companies with less debt, but again, it's not something that should prevent you from necessarily buying a stock. If all other factors are looking good, and a company has a lot of debt, that can be okay. So the best way to see a stock's supply and demand rating is to watch its daily trading volume. And IBD calculates an accumulation distribution rating. They call it their AD rating for all stocks that they cover. And that's a proprietary measure of supply and demand. So if you want to make it really simple, what's the supply and demand for a stock, you could just use that accumulation distribution rating, which is going to be A, B, C, D, or E. A is the best rating, E is the worst rating. But we can learn a lot more by looking at daily trading volume. Ideally, stocks should consolidate or decline in an orderly fashion, and ideally we want to see that happen on low and decreasing volume. And likewise, we would like to see stocks increase in price in heavy and increasing volume. So that's in a perfect world. It doesn't always work that way, but that would show, if those two things happen, that shows a strong supply. That shows a strong demand for a stock. And generally, we want to give more credence to weekly volume than daily volume, because the weekly volume just provides a better overall view, kind of a higher level view of the stock's accumulation and distribution. So let's find the S in the IBD mini charts here. So if we look on this mini chart of Gigamon, one thing I want to point out here is, so let's start right here. If you look at this box right here, this accumulation distribution rating, A+, that is as good as it gets. So in this case, Gigamon had the best accumulation distribution rating. That means that there's a lot of demand for this stock right now. Another thing IBD provides is called the up-down volume ratio right here, and that is a ratio of the trading volume on up days versus down days. So anything over 1 means that there's more volume on up days than down days, basically. So this is actually a really good number. So this is showing that there's a lot more volume on up days versus down days, and we can see this in a chart. If you look at right here and right here, we can see these big volume spikes on the black weeks where the stock's being accumulated, and then the weeks where the stock is down, like right here and here and these, are lower volume. So it's no surprise to them to see the up-down volume ratio so favorable like this. And then this here, the supply-demand rating, this is something that IBD provides for only certain stocks, and I don't know how they choose which ones for this, which ones they calculate this for, but you'll only find this in the mini charts. And it's hard to find much information about what this is. IBD just says it's a proprietary, it's like a proprietary calculation that deals with the float and some other things. So the bottom line here is, if you see this on the mini chart, it's a good thing to look at. Anything above 90 is really good, and in fact 92 is excellent. About the highest you'll see this is 95, 96, about the highest I've ever seen. So 92 is a very good number. So those are some thoughts there about how you can see how we can look at the accumulation, or this, looking at the supply demand of a stock on the IBD mini chart. Okay, so if we're looking in the IBD stock checkup, we have a whole section here about supply and demand. And in this, they provide you the market capitalization. So this is Gigamon again. Gigamon has a $1.6 billion market cap. So IBD also makes this easy for us. They give us a green, yellow, or a red dot for each of these. So at the time I took this, which was a different time than the mini chart, you can see that the supply demand for Gigamon is not as strong here. We had a D minus accumulation distribution rating, which is almost the worst it can be. E is the worst. And likewise, you're going to see when the AD rating tends to be favorable, so will up-down volume ratio. So in this case, it's 0.6, meaning that there's more volume on the down days versus up days. Another thing we get in the stock checkup that we don't get on the mini chart is the percent of change in mutual funds that own the stock. So in this case, there was a 1% change, 1% of the mutual funds that owned it dumped the stock, basically. So that's not a big change, but it's certainly something that's worth looking at. And then the quarters of increasing fund ownership is 0. It's better to see this, if you see this 2, 3, 4 quarters, sometimes you'll see them as high as like 8 quarters, but if you see that, you're going to see a positive number here. If funds are accumulating, more funds are accumulating the stock. Okay, and then we can also find the S in MarketSmith. So if we want to look at supply here, we can see the accumulation distribution rating for this particular stock is shown right up here. And I talked about debt earlier, so here is, you can get the amount of debt a company has here. In this case, it's not shown, but generally in MarketSmith it will be shown. We can get up-down volume ratio over here. Ownership right here, we can see that management owns 2% of this stock, banks own 1%, and funds own 56%. So you can get a feel here for people, for the big players that own shares. Again, management ownership is a good thing. And 2% doesn't sound like much, but depending on how much liquidity the stock has, that could be a good amount. And then mutual fund ownership right here. This is a cool feature in MarketSmith that you don't get elsewhere at IBD. It tells you the number of funds that own this stock. So you can see that this is increasing as we move on here. So that's a positive development. That means funds are accumulating, more funds are jumping into this stock, which is going to tend to push the price higher. Okay, so that concludes the supply and demand discussion. So if you don't have Bill O'Neill's book that I showed earlier, you can also learn about CanSlim on www.investors.com. And if you go to the How to Invest tab right here, you'll get this little pop-up screen here. Then you click on the CanSlim investing system, and then over here you can't really see it, but this says CanSlim. So the S is right here. You could just click on that S and you'll get a lot of the same information that I just went over here. Okay, so I'm going to switch over to MarketSmith now, and we'll look at these watch list stacks, and we'll look at some current holdings that I have, just some examples of how to apply CanSlim in today's market. So I'm going to pause this and switch over to MarketSmith. Okay, so I switched over to MarketSmith here. Let's actually start with the market analysis. So if we look at the Nasdaq here, if we start with a monthly chart, while looking at charts, it's best to start with the longer term view first, and then hone in on the shorter term. So in this case, we're going to start with the monthly, and then we're going to move to the weekly, and then finally the daily. So if we look on a monthly chart, we had the bear market. The last bear market here was the financial crisis, which ended in early 2009, and then we ran. You can see the market ran for quite a long time here, and this trend line that I drew here, this long-term trend line, was broken in August of 2015, and you can see since then, we had a period here for about a year that had some volatility, but kind of traded sideways, and then you can see on a monthly basis, you can see trade is tightening up over here. So see how wide and loose the trade was over here. You can see it tightening up over here, and now we're slowly moving up, and we're moving into new high ground. And we've moved very decisively above the old, the prior market high from 2000, from the internet era, from the internet boom. So we've just moved into high ground, and we got 3 months. It's looking like now that we're early into January here, but we had 2 months up in a row, and you can see that September was a good month. It was up, and we had some slightly above average volume here, and November was even an even stronger month. So for right now, the market looks like it wants to move higher, and we are kind of overdue for a correction, I would say, because if you look on the weekly chart, the last meaningful pullback that we had was really back here, I'd say, in about a year ago, February 2016. And since then, we've had some short corrections here, but you can see, especially since this one ended, since we came out of this in July, we really haven't had, the only pullback we had was right before the election here, which was very short-lived. So despite that, though, the market is looking good, and it looks like it wants to move higher. And the Nasdaq's also, since the election week right here, it's been hugging its 10-week moving average really nicely as it moves into higher ground. So I'd say that's the first line to really watch here if we do start having some kind of meaningful pullback. And you can see over the past month, we had some quiet volume here over the holiday period, but before that, we had some decent volume. So looking on a daily chart, again, the Nasdaq, it's making a new high, new all-time high. It bumped into the 5,500 level here, and then pulled back a bit, and now it's moved up through it. It did that on a Friday, so volume tends to be lighter on Friday, as it was a lower volume day here. But you can see here I marked this is where the election happened. We've been pretty much moving nicely higher since then. We had a little pullback here, but and then the Fed announced the rate hike over here. So for now, the market looks like it wants to go higher. If we look at the IBD 50, starting with the monthly, you can see that this index since August, so about 6 months, has basically been moving sideways. So not a lot of progress on this in terms of growth stocks. and you can see that here on the weekly chart as well. You know, pretty much been moving sideways in here. There was a nice uptrend back in here, and there hasn't been a lot happening since then. So if you're investing in growth stocks and you're not seeing a lot of movement, this is this is one indicator of why growth stocks just aren't outperforming the market right now, and they're actually underperforming. Okay. Let's move on to let's take a look at some watch list stocks. The first one's Weibo. These are just some stocks I'm watching. So Weibo had this really nice couple handle back here. It moved up, as you can see, it's up 134% from that pivot. It moved up really nicely, and it formed a flat base here, a second stage flat base, which IBD didn't note this as a flat base, and MarketSmith doesn't either. But in my book, it's close enough. So it broke out of this flat base, and then the breakout failed. So in my opinion, this is a first stage formation here, and it's looking like a double bottom if it keeps moving higher. As we had this low here, the 41.26, and then we undercut it as we approached 40. And you can see that the stock is, it found support at 40, and now it's moving up. We had a gap up day here in decent volume. So I'm looking for this to break through the 50-day, and then to break the sloping trend line. And then you can also use this 52.49 double bottom entry. So those are a few buy points you can look at here for if you're considering to buy Weibo. I'm just going to look at the daily charts on these watch list stocks for right now. Glaukos Corporation. So this is another one that I've been watching. This one broke through its 50-day moving average recently, and on Friday it actually gapped up, had a very strong day, gap up day, finished at the top of the range, heavy volume, and it broke this sloping trend line here. So this in my mind is buyable right now. I don't own this because I don't have buying power. I have 5 stocks already. I don't buy any more than that at any one time. But it broke through the sloping trend line. It also broke through this prior high right here. So you could look at this as kind of a little handle area here. So it broke through that as well. So I'd like to see this move up and form and get closer to the buy point and then form a handle, as this handle is a little low in the formation. But you could use this 36.70 prior area right here as a buy point. You could also use this area up in here around 39 as another possible entry. This stock is actually, I need to remove that. That's actually not supposed to be on my watch list anymore. Health Equity. This is another one I'm watching. This is forming a second stage flat base, and you can see I got a sloping trend line shown here. So this is finding some nice support around 40. Trading's been very tight, and so just looking for a break of that trend line would be a potential entry point. Also, you could use the 42 level right up here as a potential entry. You could also use, we had a prior highs here around 43 you could use if you want to get in early before it, if it goes on to break out of this $45 level. Those are some points you could get into this early. And then AMN Health Services. This one's looking really nice, I think, because although it's a third stage base, so it's a later stage base, it's a long consolidation. This is 107 days, so there's been a lot of time here to shake out the weak hands, and the stock is now forming a pretty long handle area here, but it's moving mostly sideways, and volume in the handle area you can see has been very light, and you can see it even more, I think even more so on the weekly chart. You can see how we've got light volume here in the handle, so that's a really positive development. So does that mean this thing's going to break out and run run up 50%? No, but this is it looks like a pretty good consolidation. So some points to consider buying this one right now. It's underneath the 10-day moving average, this green line. So you could use a breach of that as an early buy point. You could also, if you don't want to wait for the 40-40, we have a prior high here at 40, 39.90, and 39.80. So basically you could use the $40 point to get in a little bit early. We could draw a sloping trend line on this, but that's not going to get us in a whole lot earlier. In fact, I'm going to do that right now. We'll leave it there. We'll see. Might be another point to get in early on this one. So those are some current growth stocks. I keep a separate watch list for recent IPOs because I like to own at least one of these at any given time. Polar Power, this is probably a stock you haven't heard of yet. This stock has really high earnings growth and sales growth here, which is really what caught my eye on this one. And it IPO'd at $7, and you can see the first day it traded down near $7, and it closed way above that, and it hasn't gone near the $7 level since then. And this thing did form, I thought, a little base here that it broke out on this day, and then that breakout has failed. And now IBD, or MarketSmith's calling this an IPO base that it's forming. So this is one to keep an eye on. You got some early entry points here. You could use this 10.09 level. You could use this 10.45 level if you don't want to wait for this breakout up here. But with numbers this high, it's hard to imagine that this stock won't continue going higher. Chore Holdings. This one is way extended, as you can see, and it formed a nice IPO base right here, broke out on this day, and then this thing just shot up big time since then. What I'm watching for this one is, since this thing moves so quickly, I'm watching for it to come back and test the 10-day line and maybe find support there. And I might take this as a shorter term trade, just buy it off a bounce off the 10-day line, and you maybe use the 10-day line as my stop. But this one's not even close to being viable right now. It's way too extended, 17% from the pivot. And then this is another one, Smart Sand, which I'm doing the same thing with this one. You can see this one's been running up in a really nice channel here. If we kind of draw channel lines like this, it's been running up in a really nice, relatively tight channel. It's been holding the 10-day moving average pretty much the entire run. So I'm doing the same thing with this one. This hasn't formed a base really. I mean, you could call this a base down here. I probably would actually. And since then, there hasn't been another one. So I'm going to watch for this one. I'd like to see this, if this thing pulls back in low volume to the 10-day moving average, I might consider taking a short-term position in this just to catch a little bounce off that 10-day. So those are some watch lists, just some ideas for watch list stocks. So let's go through, I'll just share what my current holdings are. Trex is the first one. So I bought Trex back here when it was in this double bottom base. It broke out, or it broke this sloping trend line back here. And it had also had a gap up on the earnings report right here where it closed above the 50-day. So I took a position in here. Then it went on to break out of the double bottom, and it ran up pretty quickly, and then it's consolidating now, which is not unusual for a move like this. It moved up 15% in a couple weeks. One good thing here is the bottom of this base, it's forming a flat base, a second stage flat base. The bottom of that base coincides with the top with this prior high. So it's finding support at that prior high, which is that's a good development, because that means that this prior resistance has become support. The stock was just added to the IBD 50 as well. It is viable right now. if you look at the sloping trend line here, it's well, maybe it's not quite viable, but it's really close. You could use, if you want to get into this early, instead of waiting for this 72.21 buy point, you could use the 69.83 up in here. You could also use the 70.35 right here. I'm sitting tight for right now. I did add to the position up. I think on this day I added to the position, but this one's looking good, and this is viable right now. If you want to try it, give a shot, an early shot at this flat base. Okay, Netflix. Netflix is a slower mover, but you can see it's been moving up nicely here. I bought it down here as it formed a cup with handle, and I got kind of lucky here because I caught the very bottom of this handle area. But what I saw here was that this prior high, 111.85, it found support on this day. So that was when I started buying this, and then when I drew a sloping trend line here on the handle area. So I bought the rest of it in this area, and since then it had a breakout. The breakout day was right here. Volume was above average, but not hugely above average. And then it followed up the next day, closing up, and we had some good volume on that day, closing at the top of the range. So Netflix is looking good for right now. But again, this is a slower mover. If you look at this on a weekly, you can see all this tight weekly trading action right along the 10-week line. And then we have a breakout week in above average volume. So this is a good one, but don't expect this to run up 20% in 2 weeks or anything. It could happen, but it's just unlikely with such a huge stock like that. Dave & Buster's. So I bought this one on as a short-term trade when it had this viable gap up move up here. It had a gap on earnings report. Volume was huge. It finished at the top of the range, and you can see since then it's just been trading tight and sideways, and volume's been pretty low. So that means that institutions are either quietly accumulating more shares in here, or the people who bought it that bid it up here, a lot of people had to bid the stock up this day. They're holding on to their shares. This thing didn't crater down. So this one's still okay. It really hasn't done, I'm not really up or down anything on this, but it did just form a 3 weeks tight pattern as well. So you can see that the breakout week here had huge volume, and then we've got light volume ever since. So this thing could trade sideways till the next earnings report, which is in March, or if it breaks out of this 3 week tight pattern, it could go higher before then. So this is a shorter term trade for me. Same with this one. This is a shorter term trade. This one, I owned this up here. I actually sold it right before the earnings report, and it was a good thing because it tanked big time. And I noticed that it was drifting down in this nice channel, nice defined channel. So it broke that channel on this day. It had this gap up day on heavy volume. So I bought it, and I thought I'll just ride the 10-day line, see how it goes. So this isn't like a typical trade that you would read about in Bill O'Neill's book, but this has been going nicely since then. It came through the 50-day and it found support there, and it's found nice support at the 10-day. So I'm just going to keep riding this until it either breaches the 10-day. If it goes above the 200-day moving average, if it keeps going up, I'm just going to hold it. ATH, Athene Holding. MarketSmith doesn't show this as an IPO base right here, but it basically, it came up, it had a little pullback here, and then it broke out. So I own this stock. It broke out, and then it's been pulling back a little bit, although it's been holding the 10-day, which is good, and it's been holding right around this price level. So it's okay. It's not great right now, but it's okay. This one really attracted me because of the price. The IPO price was $40, and it opened well above that. And these high-priced IPOs, you might think back of like Acacia which I think was around the $30 IPO. These higher priced IPOs just tend to be higher, higher price just tends to mean higher quality, a higher demand. So this also has decent earnings growth, and sales growth is really good. So I like this one a lot in terms of recent IPOs. It hasn't like taken off yet, but it I'll be surprised if it doesn't go higher. And Nvidia is I believe this is my last. No. So Nvidia, this stock has been running for a long time. This was one of the best performers, if not the best performer of 2016. And I drew a couple channel lines here connecting these highs as it's moved up. And you can see that it moved up nicely here. We then had this week where this was the highest weekly spread and the highest weekly volume in this move. And then the stock kept going higher, and you can see that it was moving up at a pretty steady pace here, and then that move accelerated upward, and it's gone kind of parabolic here. So I actually shorted this, which is just, I just was taking a chance here, seeing if I could catch the top. This week here, this is the week when I shorted it. It reversed off a new high off 120 and closed towards the bottom of the range in heavy volume. And this was after it breached these channel lines. See how it got like decently above these channel lines. So when a stock goes parabolic like that, this was basically I concluded this was a climax top. I actually sent out a note about this. You can find on our meetup page. I sent out an alert about this. But it had this huge gap up move, and then we had a gap up move here, a gap up here, another gap up. When you get 3 gap ups in a short period like this, after a stock's made a big run, and it also made this run out of a third stage base. This was a third stage base. It ran, about 100% out of this third stage base. And so it was pretty extended up in here. So I took a chance and shorted the thing. For now, it's finding support around 100. So if it doesn't come down, I mean, if it goes back up, I'm gonna have to cover this and probably break even. But usually when a stock goes parabolic like this, it's gonna have a pretty sharp pullback. So I'm surprised that it actually hasn't pulled back more than this. But again, this is not like a trade I've read about in a book or anything. Just something if you see a stock making a climax top, one that comes to mind is Ambarella. This made a climax top back in 2015, about a year and a half ago, and you can see after it peaked here, it came down about 15%, and then it came back up. It tried to break out again, and it failed. And then from there, from the 130 level, it came down as low as $33 a share. So if you shorted anywhere up in here and caught anywhere down in here, you had a really good return on this. So I was kind of looking for the same thing to happen with Nvidia, but again, who knows? It could go higher. Only time will tell. All right, and the last stock that I own is Antero Midstream Partners. So I bought this one down here as it broke this sloping trend line, and it also moved back up above the 50-day. And this one's been great ever since. It came up here, flirted with the buy points. It consolidated a little bit here, went sideways in low volume, and then it had a gap up breakout day last week in heavy volume, and then the next day followed up very strongly. You can see that volume was 105% above average. It finished at the very top of the range. So this stock looks really good. I wouldn't buy this right now. It's extended, but if you did buy this one earlier, this one's looking really nice for right now. All right, in terms of recent trades, I think one I'll look at here is Align Technology. So this is one I bought this in this flat base. Well, it had this. I bought it when it broke this trend line here, and it tried to break out right here, and then it failed. And then it tried to break out again, and it failed. And then it broke out again. It looked okay for a couple weeks, and then it failed again. So this thing's just been going sideways for a little too long for me. And all these failed breakout attempts just kind of turned me away from it. Plus, I wanted to buy some other stocks. I wanted to buy Nvidia, which was I thought, a higher probability trade than this. So I did dump this one recently. Let's see if I have any other recent trades to talk about. I don't think so. This one was a while ago. I haven't sold a lot lately. I've been holding a lot of stuff recently. The stock's been doing okay. They've been hanging in there. Okay, so that concludes the presentation. And if you found this video on YouTube and you're not a member of the meetup group, then you can join by following the below link. You do need a free meetup account, which only takes about 5 minutes to set up. And I'm going to have to update this because I do have files on the meetup site that you can't find through YouTube, but Meetup just made a change for 2017 where you can't upload files anymore to Meetup. So I'm going to have to find a new place to put these files. I'm just going to email out this one for right now. But if you are a member of the Meetup group, I do send out a message that these videos are available on YouTube, so you can take advantage of that if you join the Meetup group. And I also send out occasional messages to the Meetup members with if I see a stock doing something really constructive or something really interesting happen or a cool article or something. I do send stuff like that out to the Meetup distribution. No questions from last month from any of the members. And for future topic, we'll cover the L in CAN-SLIM, so we'll keep going through till we finish the CAN-SLIM acronym. I'll probably also do a little book review. I just finished the new book, new to me, called Insider Buy Super Stocks by Jesse Stein, which was a really great book. I recommend that. I'll probably do a book review on that, like a little book report. And for the next meetup, I got some of the members had interest in a kind of a webinar-based virtual meetup. So I'm going to send out an invitation for that for February. So keep your eyes posted for that. Hopefully some of you can participate in that. If you have suggestions for a future topic or questions, just send me a message through Meetup, and I answer all those emails I get. All right, thank you, and Happy New Year to everyone, and I'll see you next month.